I am joined by Simon Ree, the founder of the TAO of Trading and an options expert. Simon, welcome to Forward Guidance. How are you doing over in Singapore?
Oh, I'm really well, thanks, Jack. Thanks for having me. Big fan of the show.
Simon, I want to get into it. You are a trader, and you have a lot of views on the common mistakes that people make in the market. But first, we got to hear about your background. How did you first get into finance? I know you were at Goldman. What were you doing there?
Sure. So my, I guess, introduction to finance was in my second last year of high school, and that was the year of the 1987 stock market crash. And I was studying economics as one of my, high school subjects, and I had a great economics teacher at the time. And I'd had a passing interest in the stock market, and really the '87 crash really captured my attention and my imagination. I didn't have any skin in the game at the time; I was too young, but I just found the whole episode really fascinating. And I thought to myself, yeah, I want to do something in the stock market when I grow up. And even as a kid, as a teenager, I'd open the newspaper. We had newspapers back in those days, and I'd read the share tables at the back. And for some reason, I just was transfixed by the whole thing. So I studied economics and finance at university, and my first job out of uni was as a futures broker. And I mean, that was great. Got a good introduction to markets and derivatives. I just didn't find frozen orange juice and bales of wheat as exciting as Microsoft and Dell and companies. So I still had that itch that I wanted to scratch. And then it was 1996. I joined Goldman. I'd had a fairly strong derivatives background from my work experience up to that point, and I built a business around options, trading options, more specifically selling options at that point in time. So built a business, and then in 2003 moved to Sydney to head up or found and head up the markets desk for Goldman within Australasia. Did that until 2010. And then I got headhunted by Citibank in Singapore. So I moved up to Singapore, which is where I am today. Worked there for 6.5 years. And it was, I guess I got to my mid 40s and started asking myself some of those tough questions, like what are you doing with your life? What is your marginal contribution to society? And I just didn't really like the answers I was getting back because really I'd spent my whole career working with and helping people who were already incredibly wealthy either stay that way or become even wealthier. And I've always been fascinated by teaching, imparting knowledge. It's something I've always loved doing. And I just thought, you know what, it's time to use the skill set I've developed to help people who could really benefit from it rather than people who've effectively already made it financially. So I left the corporate world, basically retired from that world in 2017, started trading for myself full time, and then through meeting mutual friends and mentors, wrote the book and set up an online education company, helping fast track people's path to successful trading.
How do you define successful trading? What does that mean to you? And yeah, what are the common pitfalls that people make?
Successful trading is, I guess it comes in stages. That the first stage is not losing money. And most people get into trading with this almost lottery ticket sort of mentality of, oh, I'm going to trade and I'm just going to make millions of dollars. And it's essentially gambling. The people sometimes associate trading with gambling, and sometimes those analogies actually work quite well. But there's an important difference. A gambler is looking to make an outsized return for little or no effort. That they're looking to generate something that they know they're lucky to get away with. Um, Trading, I think the motivation is very different. You're putting in the hard work, you're doing the work, and you are playing probabilities. And you know that you're not going to win every trade because there's a reason this job is called trading and not guaranteed profits, right? It's because we're dealing with probabilities, not certainties. But if people could approach trading with this idea of I'm just going to master the art of not losing money, provided they're following a practice that gives them a probabilistic edge, success is almost inevitable. And the second stage of success is becoming consistently profitable and being able to make returns that you just wouldn't be able to make as a buy and hold investor.
So when we say success is inevitable, I think for someone
Almost
with a certain
inevitable.
disposition who maybe perhaps such as yourself, who's obsessive about it, who understands the concepts, who has the temperament also, temperament much more important. I mean, that's what Warren Buffett said, temperament much more important than just raw intelligence. Perhaps, yeah, success has a higher likelihood than, but a lot of people are doomed. Like a lot of people who are trade, do you agree? You know, they work 40, 50, 60 hours in a job that's not finance. The odds that they are going to trade the market and beat the market, to me, over a long-term basis, to me, it seems slim to none. And a lot of, academic experts as well as investors have said the same. Is that true or yes or yes?
I'd say it's not true.
Okay.
The first thing I'd say is don't care about what the market does. Okay, all you should really care about is your own account. Okay, your job as a trader is to manage your portfolio, the NLV, the net liquidating value of your portfolio, so that it grows consistently over time. Okay, you don't care what the market does. You're not trying to beat the market. You're just trying to generate consistent returns. Um, as an options trader, I'm particularly passionate about options. You can make money in rising markets, you can make money in falling markets. All you're trying to do is book incremental gains. All right. You're not trying to earn your retirement on any single trade. You're just trying to be consistent and book incremental gains. Now, consistency is a superpower, and it's something very few people have. I mean, the reason why most people don't have the body or the physique that they would ultimately want is because they can't consistently follow a few very simple rules. And it's the same for trading. There are just a few simple rules that you need to follow with any good trading plan that, if followed consistently, will yield results. But it's that consistency, it's that discipline, it's that showing up every day that eludes most people. It's certainly not lack of sophisticated financial knowledge. It's certainly not lack of IQ or intelligence. It's really just that consistency and that ability to show up every day.
When you were at Goldman, what were the strategies that you did to sort of make money? And what are the strategies you employ now, and as well as you teach about? So the buying, oh, I'm going long Apple, shorting Microsoft, that doesn't work. I mean, I know people for whom it has worked, but it's sort of like, if it works for them, it's by definition someone else has to sort of lose because the market is the market. So what are sort of your strategy? You said you like options, you like short term things. I know you're also a technical trader. So what is sort of your recipe for success?
So, what I'm always looking for, Jack, is high probability moments in time to enter the market. All right. So, my default position is cash, and I'm only going to put my cash to work when I see a really good opportunity to do so. So, here's an important point. In the way I think about what I do, and in all of my self talk, I'm not a trader. I'm a risk manager. Okay, that's how I think of myself. That's how I talk about myself, and I place a high bar on any risk that I'm going to take. All right, it's got to tick lots of boxes. I always say I need three or four reasons to get into a trade. I only need one reason to get out of it. All right, so risk management is always paramount, and that's what I see my primary role as. So yeah, I use technical analysis. I use charts to identify those high probability moments in time. And what I'm looking for primarily is trends. And I'm looking for a high probability moment in time to join a trend, whether it's an uptrend or a downtrend. What has been certainly more relevant over the last year, certainly since 2022, in addition to that, is counter trend trading, where we're looking for high probability turns in the market. And that's because the market's been volatile, it's been very choppy, moves haven't had a lot of follow through. You know, when you're trading a bull market, all you really need to do is just buy the dip. You just buy every single dip, and it's really not that hard. When you've got a bear market, like we had in 2022, you can't ignore the counter trend rallies. Yeah, I mean, shorting is fine, but you'll get wiped out if you get caught up in a big counter trend rally. So you really have to trade both sides of the market, long and short, at the appropriate times.
You trade equity indices, ETFs, individual names, commodities, and then also what ticks you for what triggers you to go enter or exit a trade? Is it purely technical? So yeah, just break down for me and the audience,
Yeah.
like what are you trading? You know.
Yeah. So I trade options on stocks and ETFs.
Mhm.
So I'll trade indices, I'll trade sector ETFs, I'll trade a bunch of single stocks, usually the larger, more liquid names. And yeah, I'll buy call options if I want to go long. I'll buy put options if I want to go short. We can talk more about that if you like. And what I'm looking for is specific technical criteria. So I've got 3 or 4 trading methods that are my bread and butter. I've built scans for them, and I literally run those scans every day, looking for opportunities. So I'll run a scan that will, some days it might show up no results, some days it might show up half a dozen, sometimes I might get 50. If there's 50 scan results, I'll rank them in descending order of market cap. So looking at the largest, most liquid stocks first. And really what I'm looking for is stocks that A, meet the technical criteria, but also B, look right.
Mhm.
I want to see stocks that are actually making higher highs and higher lows if I'm looking for an uptrend, or lower highs and lower lows if I'm looking for a downtrend. I want to see some evidence that what I'm expecting to happen is happening. And so then I'll enter a trade and just manage the risk very carefully. First sign of trouble, first doubt I have on a position, I'll just get out. My job as a risk manager is to prevent small losses from becoming big losses. That's been a very important lesson for me, is keeping losses small. If the stock ends up doing what you thought it would do and moves in your direction, so what? You can always get back in. Trading costs these days are de minimis, often even zero. It's really only ego that prevents us from getting back into a position that we just got out of.
Right. So let's say it's options on S&P 500 or SPY, the ETF for the S&P 500. Would you ever be buying a S&P 500 a call option on SPY and then shorting it to sort of have a delta neutral position, or do you only trade options on the ETFs, or do you trade them themselves?
No, I mean, what I would do if I was looking to hedge a position, what I might do if I've got long positions in, Apple, Microsoft, JP Morgan, for example, and I'm concerned about, a CPI print that's coming up, I might buy some SPY puts or some triple Q puts, or something like that. But again, hedging isn't something that I would do on a whim.
Mhm.
I've got a specific sort of risk dashboard that I follow, a hedging checklist. I will put a hedge on if my process tells me that now is an important time to do so.
Well, Simon, the word hedging is just making me so emotional. We got to get into it. The word hedge. It's like, don't worry about it. You're hedged. I have a stock. I own this stock A, stock B, stock C. I can hedge it by shorting a basket of stocks. I can short S&P 500 futures, but I'm just changing my risk profile into a different blend of risk, that I may be taking my beta exposure down, but I'm increasing my exposure to the spread between what I own and what I short. So I think a lot of hedge fund managers say, oh, the stocks that I own, because I'm so smart, they're going to go up and I'll short the future that the herd owns. But it's like, sometimes the herd is right. Sometimes you're wrong. So if you're wrong, you get, and this is the banks, like with people talking about interest rate hedging, where there are a lot of good points. And like, all of the very large banks have very sophisticated hedging programs, and some of the regional banks do as well. But the idea of, if you own a 10-year treasury bond, oh, you're gonna just hedge the interest rate risk out. It's like the 10-year bond is interest rate risk, so you're just, now you have a swap spread risk. So I'm getting into my own little hobby horse. But talk to me about hedging. Like, how do you think about
Yeah.
hedging? Because the idea of, like, if I own 10 Apple shares, the way to get rid of the risk is to sell the Apple shares, not to, right?
Yeah, well, so the way I think about it, hedging to me, it's a more relevant conversation in a bull market. All right, we'll talk about how to trade a bear market in a minute. In a bull market, let's say I'm long some call options in some, you know, large market cap stocks, and the trend is up and everything looks fantastic. Uh, that is when you want to hedge. All right, you want to hedge when everything looks amazing. All right, if you, I always get people saying, "Oh, what do I do about hedging? After the market's fallen 10%." Well, that's like buying house insurance after your house has caught fire. It's like applying for life insurance the day after you fail the medical. Right, you've got to be preemptive about this. So the way I approach hedging is if we're in a bull market, I've got some long positions on. If the market gets to a point where it is probabilistically likely to revert to the mean because it's stretched a long way away from the mean, I'll do some hedging. I'll buy some SPY puts or some triple Q puts or put spreads or something like that. Now, as we know, markets can get crazily overpriced. And if that happens, I don't want to bail on all of my long positions because there still could be some juice in the tank. But just as well, I don't want to get caught if things do fall in a heap because markets are overextended. So when I buy a hedge, I'm honestly quite prepared to lose money on it.
Hmm.
I'm not necessarily looking at it as a profit center, but it's just part of my risk management. So I've got a very strict rule. I will go to cash if I have a portfolio drawdown of 15% from a high watermark. I will sell everything and go to cash for a minimum 24 hours. Now, doing that isn't a lot of fun. And so what I do is I implement strategies that make that extremely unlikely. Hasn't happened to me since October 2018. But that's part of why I hedge. So it smooths out the fluctuations in my NLV, which means it smooths out my emotions, which means I'm in a better position to make high quality decisions.
Right. And when let's say you in a bull market you own calls on SPY, the S&P 500 ETF, things are going well. You're making a lot of money. You decide to hedge by buying S&P SPY puts. Tell me about that, because when you buy SPY puts, you're reducing your delta. So it's basically like you're selling stocks, but then you also have a volatility exposure. And I believe that buying a put is the same thing as shorting the stock and then buying a call. So you're basically buying more volatility. Like, so you have a view on the actual underlying is 405, is that underpriced, overpriced, whatever, and then you have a view on the volatility. So why not just sell the calls instead of buying the puts?
Yeah, I would. If my long exposure was SPY calls, I would just sell the calls.
Mm-hmm,
But
okay.
if my long exposure was a basket of, you know, somewhat correlated stocks, uh, and I thought that certainly, if the index might be looking overvalued, but some of these stocks still look like they could run, by implementing a hedge and spending a small percentage of my NLV on doing that, it's going to be a little bit of a drag on my portfolio if things keep going, but that's fine. It's going to be an absolute godsend if things fall over.
How do you trade a bear market?
So with a bear market, I find that with a bull market, okay, you can pretty much ignore counter trend moves. All right, if the market gets really overextended to the upside, like I said, I can just buy some SPY or some triple Q puts or something like that. I'm not looking to trade individual stocks short. It's just not worth it in a bull market because really you're looking to buy the next dip. In a bear market, there's a lot more two-way price action. All right, the counter trend moves in a bear market can be massive. You can see 15, 20, 30, 50% rallies and still be in a bear market. If you look at the tech wreck from 2000 to 2002, the Nasdaq had 8 rallies of 25% or more, and it had a couple of rallies of 50 or 60%. All right, if you're just trying to short the market through all of that, you're going to have a really tough time. So in a bear market, I'm far more likely to be taking directional positions long and short and looking to trade both sides of the market rather than putting hedges on top of a portfolio of positions. And generally, I guess the holding period tends to be shorter in a bear market as well. As I said, the positions or moves tend to have less follow through. They tend to change direction a little more quickly. So in a bull market, I might hold positions for 2 to 4 weeks on average. In a bear market, it might be anywhere from 2 or 3 days to a couple of weeks.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world, and this year Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and permissionless is something you might want to attend, what I'm saying is there's no time like the present because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. Walk us through the bear market that started in January of 2022. What is the nature of this bear market? Perhaps you can compare it to previous bear markets. And what strategies have you found have worked the best throughout this bear market? And in particular, I'm referring to the aspect of chop, where this is not March 2020 in any regard, not
Mhm.
2008. It's this slow grind down. And then after a big move down, all the bears get all excited. They're going on all the podcasts talking about how it's time to be bearish. And then you have a huge move up and that just obliterates them. Uh,
Yeah.
and we're kind of at the tail move of that, maybe where we've had a banking crisis and everyone's looking at the Fed's balance sheet and getting very bullish, and probably S&P 500 is up 8%, 10% since the failure of Silicon Valley Bank,
Yeah.
just over a month ago. Yeah, so just tell me about the nature of this particular bear market, and yeah.
Yeah, it's as you say, it's been fairly different from, well, yeah, completely different from 2020, but also very different from 2008. In both of the previous falls, we had kind of volatility exploded, and it was, when volatility kind of has a big move, it sort of becomes a little bit more predictable. Volatility is a real mean-seeking beast. What we've seen in 2022 is, I think, volatility has really underperformed most people's expectations, given what happened to the market, particularly the Nasdaq. And so it's been a surprisingly orderly sell-off. There's been an absence of sort of abject fear. I mean, we've had a couple of spikes in the VIX above 30 or above 35, but that's been about it. We haven't seen anything truly scary. And some people are sitting there kind of waiting for the big one. They're saying, "Oh, the VIX hasn't hit 80, therefore we can't be anywhere near a market bottom." Whereas other people are kind of pointing out other market dynamics, such as zero day to expiration
Mm.
options and their rise in popularity and the impact that might be having on realized vol. Um, so yeah, it's every kind of market cycle is different. I guess the big difference with 2022 was the simultaneous fall in stocks and bonds, and that's as a result of the inflation regime. We had many calls throughout last year of, now's the time to buy bonds. Well, no, actually, now's the time to buy bonds. Well, now's really the time to buy bonds. And
Simon, everything before it was just a test. This now is the time to buy bonds.
yeah, yeah, correct, right. So that's really kind of thrown people offside. To me, it's, if you're following trends and following technicals, it's fairly easy to avoid mistakes like that. You just wait until the trend is reversed and you start, you know, buying the first higher bottom rather than trying to catch the falling knife.
Right. So I want to explain a few things. You said volatility mean seeking. That means not referring to whether it's nice or mean, like the average. So if it
Yeah,
goes to 8, if the average is 16, it might go back to 16. If it goes to 80, might go back to 16. But it's also clustering. So if it goes to 40, it could go to 80. And then you said volatility really like failed as a strategy. You're saying that even though we had a bear market and stocks went down in price, it wasn't an explosive sort of crescendo of liquidations where 3% down on Monday, 4% down on Tuesday. It wasn't, there was no Black Monday, Black Friday. There was, and as such, people who bought volatility for protection generally didn't work. If they bought a put option, it worked to the extent that the market went down, but it didn't work to the extent that realized volatility was probably lower than implied volatility. And earlier when you said IV percentile, that's implied volatility, and you said the VIX. So yeah, and the easiest way to see that is that we know VIX above 45 or let alone 50, and the VIX is 30-day implied volatility on the S&P 500,
that's right.
and uh, but a lot of the action now is happening in the 0-day to expiry options or very short expiry options. Yeah, tell us about that. What's going on the zero data expiry space? How big of a force is this on the mechanics of the market, and how different is it from, let's say, 5 years ago, or versus when you were a Goldman?
Look, if I showed you a chart of the S&P 500, a daily chart over the last year, and compared that with previous downtrends, I don't think you'd look at it and say, "Wow, look at the difference zero data expiry options has had on the market." Look, I think it probably exacerbates intraday volatility. I think it probably helps to um, depress volatility, uh, implied volatility, because most of the action is in people selling vol, not buying vol.
Mhm,
Um,
mhm.
there's been a lot of hand wringing about, is this going to be the next kind of cataclysm to hit the market? I'm not convinced. I'm fairly, I guess I'm fairly sanguine about it at the moment. I haven't seen any compelling evidence that this is something I should be losing sleep over.
There's a lot of price action that to me seems weird. You talked about the intraday price action, like from 9:30 to 9:40. The market's it's always a reverse of the move. Whatever the market does on a Fed meeting from 2 to 2:30, it always is the reverse. There's these epic intraday reversals that if you're just looking at a daily chart, you're going to miss them. Yeah, how responsible for that is it? To me, like, I'm just some guy, I'm just some kid. Like, it seems weird to me, but I don't have the background that you have. Like, is it weird, or
Yeah, it's. I mean, it is kind of weird. The other thing that's you need to, I guess, appreciate is that we've been in a bear market. Arguably, we're still in one. I won't touch that argument. But what we've seen is every economic announcement, whether it's FOMC rate decision, whether it's FOMC minutes, for goodness sake, whether it's CPI, whether it's non farm payrolls, these have all become massive binary risk events. Now, there was a time, Jack, in the not too distant past where CPI print would hit the tapes, the stock market wouldn't care. It was just go on as business as normal. But we're in a paradigm now where the market is just obsessed with economic data releases, and trying to impute what that means for the Fed's next move. Clearly, the market doesn't love it when the Fed is hiking rates, and everybody's been baying for this dovish pivot. Be careful what you wish for, I think, in that regard. Um, but yeah, it's kind of unusual. I don't think it'll be like this forever. We'll get through this eventually. But at the moment, the current paradigm we're in is where every major economic data release is being treated like a major binary risk event, and that in itself is a little bit odd.
today we're recording for me the morning of Wednesday, April 12th. We just had inflation come out, and I'm seeing on website where I get the data, it was 5% year over year versus the consensus estimate of 5.2%, 5.3% year over year, and the month over month is 0.1% relative to 0.2. So it is inflation is low. So if this happened last year, and it never happened last year, that would have been good news. So I don't know. Let's see. Is the market up? I'm sure but I haven't checked yet. The market's up
Uh,
78 basis points.
we're sort of in a range. The S&P 500's in a range of kind of 3,800 to 4,200. I think unless we break out of that range, it's hard to get particularly excited about anything. I don't think we're at a generational buying opportunity. That said, I don't think markets are about to roll over and die here. Not in the
Mhm.
immediate term anyway. I think that there's probably some more upside pressure than downside pressure, looking at things like that CPI print and positioning. But it's hard to get excited about a market that's chopping around in a range, and this is the sort of environment where really you just want to keep your risk small and just hit base hits. You're not looking to really extend risk or try and hit any home runs. I'd much rather try and do that in an environment where we've got a strong trend to play with. We just don't have that at the moment.
Talked about positioning. So there's going to be upward buying pressure because of positioning. What does that mean? And can you go through the argument of, oh, if everyone is, you know, is bearish, then there's no one on the margin to get bearish, because everyone's already bearish, so they have to do buying. Um, yeah.
Yeah, well, if you look at positioning in S&P 500 futures, it's particularly bearish. Now, you never know what's on the other side of that. That could be a hedge for long equity positions, but the fact is, futures are a leveraged instrument, and these are positions that can get squeezed if they're on the wrong side of a move. All right. So if there is a strong move up, you can see a short squeeze, which causes people who are short futures to start buying back their short futures, which fuels further gains in the index.
Right. I forget some baseball players. This is a great quote. You've probably heard of that. Just because everyone else thought I was ugly didn't make me beautiful. It's
Is
like,
that a Yogi Berra?
yeah, it's the Yogi Berra quote. Yeah, like
Yeah.
if is everyone else is bearish, everyone else is positioned bearish. How convincing is that? Is a bull argument in the short term, medium term, and long term? Short term, I guess it can be very effective.
Yeah, I mean, positioning is of interest. I wouldn't ever take a trade just because positioning got extreme. But if we do see extreme short or long positioning, looking at things like the put call ratio or futures positioning, yeah, I will start to lean the other way. If I'm long and I see that the market is long, because the put call ratio got below a certain level, yeah, I will stop. To me, that's a warning to don't add any more long positions. And in fact, the next couple of positions you add should probably be short positions.
What's a warning? What's a warning?
Well, I mean, the put call ratio is a good warning.
All right, Simon. So we got this chart of the put call ratio. Thanks for sending this over. What are we looking at here? What's the green line? What's the white line? And what does it indicate to you?
So the green line is the S&P 500. The white line is the 10-day moving average of the combined put call ratio, which takes into account options positions in individual stocks and indices. And what it shows us, or it gives us a guide as to how long or short market participants are through the options market. So if you look at that, see that first big spike on the chart just to the left of center, sort of around August.
Mm-hmm.
You can imagine everybody's kind of seeing the market rally and, oh, this is fantastic. Oh, I've got to get involved. Oh, I've got FOMO. I'm going to go out and buy a whole bunch of call options. And what happens is the 10-day moving average of the put call ratio drops below 0.8. And that is a sign of excessive optimism. Everybody's long. And when everybody's long, guess what? The market tends to run out of buyers and it rolls over. And
So
then
this is
market rolls
put to call
over.
ratio. When put to call ratio is high, people are buying a lot of puts. Put is a bearish option. If they're buying
Yeah, when it's high,
call
they're
is bullish
buying a lot
option.
of puts relative to calls, and when
Yeah,
it's
so
low, they're
people are
buying a lot
buying
of.
more puts than calls. And so yeah, white is that line, and green is the S&P 500. So when you had that huge run up, into the summer, people started buying a lot more calls than puts, and the buying pressure sort of was exhausted.
That's right. And the market, you've got to remember, is an equal opportunity dream killer. It will always try and exact the greatest amount of pain on the largest number of participants possible. So when everybody's long, that put call ratio is below 0.8, uh, be on alert for the market to peak. Now, it's not a precise timing signal, but it's an important sentiment signal, and it's something that I work into my framework. So I don't run out and start shorting as soon as the put call ratio drops below 0.8, but I stop adding long positions. And if I see any good counter trend short setups, yeah, I start taking them. And the same when the put call ratio gets above 1, that's when something bad has happened. Everybody's wet the bed. Everyone on Twitter is bearish. All anybody is talking about is how much lower the market's going to go. Well, guess what? Everybody's already short, and the market is going to make the shorts feel some pain now. And that's usually when the market will put in a low. And yeah, I find that this is just one of many tools, but this is a really handy tool to gauge market sentiment and positioning. So right now, the put call ratio isn't telling us anything other than it's neutral. But if that white line continues to head towards the red line, that could mean there's another 3 to 5% pop on the S&P. And if people keep buying calls into that, that will set us up for a nice reversal to the downside.
Hey there, sorry to interrupt. A lot of forward guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some forward guidance listeners are into crypto. Some own crypto, a smaller percentage owning lots of crypto. and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. Right, and let's talk about technical analysis, which I know is a key feature of your process. I technical analysis is sometimes hard for me to understand, and I feel like it has two principles that sometimes are in conflict with each other. One is trend following. Oh, so if it's above its moving average, buy, buy, buy. The trend is your friend. And the other is mean reversion. So fight the trend, be a contrarian. The chart that we just put on previously, that was kind of the latter. It was a contrarian. Oh, when everyone is super bearish, buying more puts than calls, that's actually a time to orient bullish. So how do you know sort of which principle to follow?
Price is only ever doing one of three things. It's either reverting to the mean, accelerating away from the mean, or chopping around the mean. So you need to be able to identify what price is doing in order to, I guess, make a call on what it's likely to do next. So if we're in an uptrend and price has reverted to the mean, what I'm generally going to look for is for it to accelerate away from the mean again. Okay, so that trend to kind of reestablish itself. If price has accelerated a long way away from the mean, the odds are, the probabilities are that it's going to revert to the mean at some point. And the more stretched it gets, the more likely it becomes. And so then you might want to employ a mean reversion strategy where you're expecting a counter trend move back towards the mean. And then if price is just chopping around the mean, these are tougher environments to trade. And honestly, if I'm looking at a stock market that is just in a tight range of chop, generally I won't do anything on that index. What I'll do is look for individual stocks and sectors where there is a trend. And normally you can find a trend somewhere. If the market might be chopping sideways, but the energy sector might be on fire, or tech might be in a horrible downtrend, or you look for somewhere where there is a trend.
Okay, let's take April of 2020. I think the market bottomed March 23rd of 2020. The VIX had a top a few days prior to that, and the mean. What was the mean then? I like I was there, and it very easy to be convinced by this is a bear market rally. It wasn't.
Hmm.
It was the start of an epic bull market in
Yeah.
everything. So how do you know? How do you know? Let's say April 2020. Why couldn't you said, oh, the mean is 3,000? Things are getting excessive.
Well, the beauty of trading is you don't need to know. All right. All you're doing is assessing evidence as it comes to hand and playing the probabilities. You're not going to get every trade right. But if your process gives you a probabilistic edge, you'll win more than you lose. And if your risk management is competent, your winners will be bigger than your losers. And that's how you make a living. At least that's how I make a living. So April 2020, as you can probably imagine, we had an extremely high put-call ratio. We had an extremely high VIX. We had an S&P 500 that it was several average true ranges below its mean. And when I talk about the mean, I'm talking about the 21-day exponential moving average. And so the stars were lined up really for a strong counter trend bounce there.
Below its
Um,
rally or below its 21-day exponential moving
Yeah,
average?
it was an exceptionally long way below. So there were certainly the stars were aligning for a major bounce. I'm not saying I called the exact bottom, but I was certainly bullish. In fact, I was bullish a little bit early. I got bullish a little bit about a week early, and I was posting on social media, and the insults that I copped at the time was, yeah, I really had to grow a lizard skin. But yeah, it sort of, I could see that the market had reached a crescendo of panic. And at the very least, we were due for a sizable dead cat bounce. Now, I didn't know that it was the bottom and it was the start of a massive bull market,
Mhm.
but I didn't need to know that because all I was doing was just reassessing the evidence as it came in and trading accordingly. I'm not one to make big, bold predictions. I'm not going to sit here and tell you the S&P is going to hit 4,600 by December or 3,000 by December. I'm just interested in watching how things unfold and just following my process and taking advantage of those short-term moves.
How else do you assess current market conditions? I'm thinking of the Jesse Livermore book, Reminiscence of a Stock Operator. You always got to focus on market conditions. The modern way of thinking about this is talking about liquidity, a term that means many different things to many different people. Like the Fed's balance sheet, like if stocks markets go up, there's lots of liquidity. Well, why does the stock
Yeah,
market go down? No liquidity. It's very sort
yeah,
of self reinforcing logic, although I have had some liquidity experts on the show who actually have made some very good calls, such as Michael Howell. But yeah, how do you assess current market conditions? Yeah, and when you say,
yeah.
oh, your base case is kind of chop 3,800 to 4,200, what are you basing that on?
I'll answer the second question first. So what I'm basing that on is really just swing highs and swing lows. So the price has memory. If the market gets up to 4,200, it's likely to struggle there for a period. And if it can break through, we could see some follow-on, so some continuation to the upside. Similarly, if we get down to 3,800, that's likely to be a level of support. If we break through that, there's likely, the probabilities are we could see some continued selling. So it's really just looking at what price has done historically to come up with those levels. These are not, fundamental levels of S&P
Mhm.
500 earnings or anything like that. In terms of how do I assess market conditions? I mean, there's a whole bunch of things I look at. So I look at the major indices, the S&P, the Nasdaq, the Dow, the Russell 2000. I look at them across multiple timeframes. So I look at daily, weekly, monthly charts. I look at what the sectors are doing, what's tech doing, what are semiconductors doing. Semiconductors can often be a bit of a first mover. And then I look at a bunch of correlated assets. What's the dollar doing? What's dollar yen doing? What's Aussie yen doing? What are bonds doing? There's been an important correlation between bonds and particularly the Nasdaq,
Yes.
and that won't last forever. But I expect that correlation will remain for as long as we're in an inflationary regime. I look at things like HYG as a proxy for junk bonds. What are junk bonds doing? Spreads doing? If junk bonds are rallying, that's a risk-on signal for equities, and the counter is also true. So there's a whole bunch of market internal things I look at, like the VIX, the put call ratio, the skew. There's a whole bunch of macro things that I look at. As I said, I don't trade based off any one of them, but they give me a composite picture of, is the path of least resistance likely to be higher or lower from here?
So what you trade based off is the technicals.
That's right. But if the complementary analysis is screaming at me, this market is overextended, uh, sentiment is exuberant, the market is very, very long, even if the trend is up, that's when I'll start looking to fade the trend.
What technicals are you looking at now? We're talking moving averages, resistance. Yeah, like start with your most the indicator you put the most trusted, and then we'll go down for the list.
Okay, so the most important indicator for me at the moment is always moving averages because
Mhm.
they just give you a really good read on short term trend and also medium and long term support and resistance. All right, so exponential moving averages can give you a really good read on what the short term trend is doing, and then your longer term simple moving averages can act as levels of support and resistance, and they're widely watched by pretty much everyone in the market, whether it's self-fulfilling prophecy or not, I don't care. The fact is it seems to work more often than not. And that's what I'm focused on, things that work more often than not. Um, Secondary to that would be things like Keltner channels. How far away from the mean is price. Um, Also complementary to that would be things like new 20-day highs and lows, new 60-day highs and lows. Is the market showing strength? Is it breaking through these new highs, or is it failing at them? And all of these will give me ideas as to how strong the trend is and whether we're seeing kind of failures at multi-day highs, or whether we're seeing breakthroughs. And all of that gives a picture as to how strong the trend is. Yeah, I'll look at things like breadth, things like the advanced decline line, percentage of stocks above the 200-day moving average, percentage of stocks above the 50-day moving average. All of these can give you important clues as to how strong the rally is as well.
Right. And I'm just looking at a chart of the exponential moving average, and the point where it's the most below its moving average is the point where the put to call ratio was at the bottom. So you always get the signals rarely send the same signal, right? Especially
Right.
the put call ratio and the exponential moving average almost never give you the same signal.
Correct.
Yeah,
But
yeah.
they will at very important times.
Okay, okay. And it's a point of finding when they all align, that is when to make a big move, but you want to size down in periods where you have less conviction, such as now.
Absolutely. Conviction it's a word I don't like to use. I know, conviction is to me, conviction is something for criminals, and it's also something for sell side salespeople. They like selling about conviction lists and that sort of thing. If I say I've got conviction on a trade, it implies that I know for a fact that this trade is better than other trades, and I don't know that. So I generally don't size up. I'll never bet the farm on a play. I will size down though when markets are choppy and not exhibiting strong trends.
So your book TAOs of Trading, also the name of your company. What are some TAOs of trading that we haven't discussed about before that you think are really important?
So I think that we've talked quite a bit about trend identification. We've talked about market analysis. We've talked about risk management. We probably haven't touched on mindset. And to me, obtaining the correct mindset is the final frontier for most traders, and it's what will keep an aspiring amateur from their dreams of making a living from trading. And some of the things that really trip people up in when we talk about mindset are the desire to be right. All right, there's the old saying, "Do you want to be right or do you want to make money?" People think that in order to make money trading, they've got to be right all the time. And I'm telling you, if you can be right 60% of the time, you can make a damn fine living as a trader. But the problem is, from the time you were 2 years old, every time you made a mistake, you know, you, you did something wrong, your parents would yell at you. You go through childhood and school life, your mates would make fun of you. You join the workforce, your boss is going to yell at you. And so you develop this habit throughout your whole life of just trying to not stuff anything up, just trying to avoid making a mistake at all costs because of the ramifications it has. And so we end up as humans, most people would rather drink bleach than admit they're wrong. Now, as a trader, you need to be able to admit that you're wrong and identify when you're wrong as early as possible, as I said earlier, to prevent a small loss from becoming a big loss. But people really struggle with this. They think, "Oh, I'm not wrong. The market's wrong." That's a classic. Or, I'll be proven right. Or sometimes just the shame or embarrassment of being wrong is too much. They stop looking at their brokerage account, and their account just kind of withers away to zero in the background. There are not many avenues in life where you can be handsomely rewarded for being wrong 40% of the time. All right. But trading is one of them. And it's a big adjustment that people need to make if they want to be successful in this field. They've got to get over this fear of being wrong and of wanting to be right all of the time.
Definitely. What is the role of intuition? What do you have a sense of intuition that you feel because of your experience? You trust it, but also, if people
Yeah.
sign up for you, if people you're teaching people, you don't want to tell them to follow their intuition because they're new to the market.
That's a really good question. Um, Intuition will lead you astray 99.9% of the time if if you've done less than thousands of trades. It takes thousands of reps to build that trader's intuition. Markets are actually designed to get you to an emotional state where you will do the wrong thing at the wrong time. You'll chase moves that are already underway. You'll sell out at the bottom because the losses are making you feel sick because you haven't managed your risk properly. Literally, markets are set up to do this. So unless you've got thousands of trades, thousands of reps under your belt, and you've been consistently profitable, forget about intuition. One thing you can do, and one thing I share with my members to start building that intuition is whenever you look at a setup and whenever you take a trade, print the chart out. Print it out on paper, keep a record of it. And what you can do once a month, once a quarter, once a year, go through and look at all of your winning trades and all of your losing trades. And your brain will start to make connections that you probably can't even put into words. But by looking at what a winning setup looks like on a chart compared to a losing setup, you can start to build that intuition a little more quickly. Many of the lessons that the market will teach you from trading are very, very subtle. They're so subtle that unless you're really looking for them and aware of the lessons, they can really pass you by.
Mm. And now what I want to ask you is, let's say you make money trading the market. Where does that money that you make come from? Does it come from the market? Does it come from is it zero sum where if you make money trading options, someone else must be losing money trading options? Because at a poker table, if I make money, it's because someone else at the table lost money. Is it similar in the financial world, even though the table is the entire world? Or is it just sort of gains from trade? Oh, I'm helping the market discovery because the market needs to know that there's not enough oil, so I'm actually doing a service.
Yeah, I don't think what I'm doing in the market is as noble as that. I like to try and help other causes with the money that I make. But to answer your question, it's an interesting question. I don't think it's an important question for traders to have at the front of their mind because it's probably not that helpful. If you're a kind, generous, giving person and you're worried that the person on the other side of your trades is necessarily going to lose money, you might engineer a kind of habit where you actually don't make money. My perspective on this is I trade options almost exclusively. 99% of the time, I am trading with an options market maker. They're fine. All right. The Citadels of the world are fine. I'm not worried about them. Okay. They make plenty of money. And if they're losing money on the other side of my trades, yeah, I'm not going to lose any sleep over that. Market makers are fine.
For sure, Simon. I wasn't so much making a moral point. It was more of let's make some several assumptions. Let's say you're good at trading and that people who learn from you that they can get trading. If everyone at the world followed the Tao of trading, who is there to sort of make money from? Like the market itself will change. That's what I'm saying. The
Yeah,
composition.
I mean that would never happen
Yeah,
because
yeah.
there are so many thousands of different trading methodologies out there. But the fact is, as an options trader, you are nearly always going to be dealing with a market maker, and it's their job to hedge their risk. And so I don't worry about it. I just assume that they're doing their job, and if they're not, then it doesn't concern me. I mean, the way I think of financial markets is that there's trillions of dollars turning over every day. It's like this river of abundance, and all I'm trying to do is just scoop my hand in and just take a little bit out for myself that basically nobody else would even notice.
Right. All right. Well, Simon, as we approach a close, what are some of your views right now? What are trades you're actively involved in, or if you're not involved in now, you're looking at exploring, and it could be, a sector thing. It can, any sort of thing where, it's sort of catching your eye.
Yeah, so at the moment we're sort of in the early stages of earnings season. We've got obviously the major banks reporting, or some of the major banks reporting on Friday. I have not been buying bank stocks at all. The fact that banks got so hammered and didn't have a reversion to the mean is a little bit of a warning sign for me. So I'm kind of ignoring the banks at the moment. Um, but yeah, really for the next month or so, my focus will be on earnings season. Um, Earnings trades are one of my trades that I like to do during earnings season, where you kind of take advantage of the IV rush and avoid the IV crush post earnings. So that can work really well. I've got a couple of positions in some tech stocks that are showing good uptrends. Um, I've got a bearish calendar spread on the Qs just as a very, very gentle hedge at the moment. But yeah, nothing sort of sectoral specific, but really what I'm focused on at the moment is earnings season. Once we get to the end of that, it'll just be a case of taking a look at the broader markets again, hopefully we've got a more defined trend established. Whether it's up or down, I'm indifferent, and we somehow move either to the one extreme or the other of the chop zone, or break out of it. But being in the middle of the chop zone is not as much fun as a trader. Like I said, it's just a time to pare back risk.
How much time does this take? Like, let's say, you this is a full-time job for you. Sounds like you've been quite successful. Is it implementable to have success if someone has another job? Because it sounds like it's a lot of work, and if you don't do the work, you're going to get crushed.
Yeah, like I would say, learning it there is definitely effort involved, and that's another reason why most people don't succeed. All right, it's because they don't put in the work in learning how to trade properly. So there is definitely many hours involved in learning and practicing. But once, like when a golfer has grooved their swing, once you've kind of grooved your swing in trading, there's no reason it should take you more than about half an hour a day on average. Now, there might be days where it takes you an hour. There might be other days where there's nothing to do. It's just a quick review of your positions, and it might take you 2 minutes. But if you use scans that provide you a short list of high potential candidates, and it's just a case of reviewing the scan results and sort of reviewing the macro conditions once a week or over the weekend, it shouldn't be terribly onerous. And in fact, I think it's a very time efficient way of making money.
Got it. Well, before I ask my final question, Simon, as folks can see from on the screen on Twitter, you are at Simon_Re. Where can people find out more about your business and your book, the Tao of Trading?
Yeah, so TAO of Trading, it's available on Amazon. It's been a number one bestseller. And you can find more about me at taooftrading.com. That's TAOOFTRADING.com.
Thanks, Simon. My final question is: do you prefer to be long options or short options, and why?
I prefer to be long, simply because it's an easier way to compound your returns. Being short options is fine, and it's great in a high volatility environment, but I find I can compound my gains more quickly and more easily by being long, whether it's long naked options or long spreads.
And what is the sort of advantage of being long options? Said doing trades against a market maker, Citadel. If you're buying SPY call options struck at 400, Citadel is buying them. Sort of typically the theory goes that people who sell options, there's a volatility risk premium that you're paying. You're paying a fee to get access to that optionality. Like, so how do you make sure that the gains that you get from options are greater than the fee that you get based on the volatility risk premium?
This is why it is so important to be able to identify high probability moments in time to put your cash at work. All right. That's why I have a very high bar on trades that I take. I'm not taking crap shoots. I'm not trading intuition. I'm not trading something because some Twitter handle said it looked like a good idea. I'm really, I've done my homework. I've got my processes, and yeah, I'm not going to win every trade. That's for sure. Losses are part of the game, but so long as I win more than I lose, and my winners are bigger than my losers, I can make decent money.
And do you always have a stop? In other words, oh, if I lose this much money, I'm out of the trade.
Yeah, that's a good question. So I have a what I call my OMG stop loss level. So if the option premium that I've paid decreases by 50%, I'm out of the trade no matter what. No questions asked.
So you never let an option expire worthless. Never.
Never, ever let an option expire worthless. But what I'm really vigilant on is getting out of a position that isn't working well before it hits my OMG level. All right. So if I see a moving average crossover, if I see a close below a 50 period moving average, if I see two consecutive closes below a 21 EMA and I'm in a long position, that's an early warning sign. I'm sort of got my finger on the trigger, and if the 8 EMA crosses underneath the 21 EMA, I'll get out of the position.
And what
And
about the
usually,
reverse? Yeah. What if a position is working really well? Oh, if it doubles, I'm going to sell it all. If it, like, are you sizing down as the position goes up? And that's a
yeah,
nice
I'll
feeling
scale
when
out.
yeah, when you can sell something and you've only sold part of it, but you've already made money, the cost basis. Yeah.
Yeah, yeah. I'll scale out of positions. Usually, if I'm up more than 100%, I'll take some profit, and then it becomes a roadmap. I'm looking at things like average true ranges. I'm looking at things like support and resistance, Fibonacci targets. All of those will go into my decision on where to come out of a position. When it comes to options trading, I'm actually a big fan of selling too early. Right, I don't wait for I don't wait for the price to peak and then start rolling over, because then you're just joining the queue of everybody else, kind of rushing out of the theater that's on fire. I always like to leave a little bit of upside so that it's easier to sell the position on someone else.
Well, Simon, I do have a pretty horrible experience with that. By pure luck, I happened to buy a very out of the money a put option on an individual stock that was very volatile in February of 20, like late February of 2020, and it was
Oh wow!
I was a 20 it was a 20 bagger in terms of,
Oh wow!
but then I let it expire worthless.
Oh no!
I know, is that it's like, and this is the type
Yeah.
of thing where amateurs make mistakes. You would never have made that mistake. Um, and it's just it's a risk if you don't know what you're doing. It's the risk of losing money trading if you don't know what you're doing is very large.
It's very high, and you read all the statistics about how 80% of traders lose money, and sadly, it's probably true. And I think it's because the barriers to entry to open a trading account are so low. Anybody with $500 can open an options brokerage account. Now, when you want to drive a car, you have to get lessons, and you have to pass a test, and you have to get a license. You can imagine how many accidents there would be on the road if nobody bothered learning how to drive before getting in a car and driving one. But nobody makes you pass a test or get a license to open a brokerage account, which is why we see so many financial accidents.
I don't think brokerages do people a lot of favors by not showing the implied volatility, just making it seem like it's some easy purchase. Yeah, I mean, do you think that the proliferate?
Showering your screen with confetti every time you place an order. Yeah.
Yeah, is that they really do that?
Well, that was going on, wasn't it? With
I think you're right. Oh man.
yeah.
But okay, so the proliferation of options, presumably as an options expert who is working in some cases with retail investors, uh, it's been maybe good for you, but like, do you think it's good that so many people who don't know how to do options are trading options?
No, I think it's really bad. I think
Yeah.
it's really bad for their financial health.
Other than the Tao of Trading, do you have any books that you feel are kind of like the holy grail of finance, trading, or particularly options? 'Cause I feel like options is one of those things where you can learn a lot of things in finance on the job, but in options, like you really got to know what implied volatility is, the math and stuff like that. Like, is there any sort of holy grail book?
Yeah, I mean, the holy grail is Options, Volatility, and Pricing by Sheldon Natenberg. To me,
Mhm.
that was the book that I made all of my guys read when they joined the desk. That will give you, it's not a page turner, but it'll give you a very thorough grounding in things like implied volatility. And then the other book that I love is Trading in the Zone by Mark Douglas, which really deals with mindset and the emotional control, and those things are so important as well.
Final question. You've outlined your style of trading. What do you think about the other ways of making money in the markets? And the old fashioned style of, oh, there's this company and I'm reading the annual report and I'm gonna buy the stock and hold it for 30 years. Like, how do you sort of place your type of trading in the sort of panoply of investment strategies?
So it really depends on an individual's objectives. So if you're a let's say you're a long-term buy and hold investor, and the long-term average annual return of the S&P 500 it's approximately 10% per annum. All right. And if you're happy with that return, then I think that approach is fine. But if you're going to earn 10% per annum forever, you you either need to be young, you need to sort of be in your 20s and have that kind of 40-year runway for compounding to work its magic, or you already need to have a lot of risk capital. All right. If you're sitting there in your 40s or 50s and you don't have $1 million saved up, and maybe you've only got $20,000 saved up, 10% per annum, it just isn't going to move the needle. All right. So you need to do something else, whether it's trading, or whether it's an online business or working a second job or whatever it is. Um, Buy and hold investing, earning those sorts of returns is unlikely. Well, it's just not going to move the needle for you. You don't have enough runway if you haven't got a large amount of capital.
Right. But that's the assumption that, everyone is going to become everyone's goal is to become very wealthy. And also,
No, not very wealthy. I'm just talking about being able to fund your retirement, but being
right, right, right. But obviously, if everyone had a choice between a guaranteed 10% return or a guaranteed 5% return and a guaranteed 25%, if strategies that generate higher returns are riskier generally.
strategies that generate higher returns require more effort. This Wall Street has been peddling this story forever that high returns, high risk equals high returns. But we need to think about what risk actually is. Okay, risk is the possibility of losing. All right. So, really, what Wall Street has been telling us is if you want to maximize your chance of winning, you got to do that by increasing your chance of losing. And I would ask you, how does that make any sense at all? All right, I've got a different theory which I talk about in my book, and I would postulate that if you want to maximize your chance of winning and getting great returns, you got to do everything you responsibly can to minimize your chance of losing, and that's
Mhm.
through high probability setups, proper risk management.
And I see what you're saying. You're saying you have a protocol where oh, I'm never going to lose more than 50% on an individual position. If I'm down 15%, or forget the number from the total value, I'm going to go completely to cash. But the trade, it's all in the individual, right?
Mhm.
Individual is piloting the plane, and if they're reading the Tao of Trading, the best book of finance ever, if they're not getting the message or they're misinterpreting it, there are risks, and you'd say, right. Let's say, like,
Yeah,
the risk for you individually is low because you know what you're doing, but a lot of people, they could misinterpret. You get what I'm saying?
absolutely. But
Yeah, yeah.
but yeah, I spell out the risk management protocol that I recommend, and if you follow that and you're consistent and you honor it and you follow it to the letter, your chance of blowing up is basically virtually zero. Um, and then from then on, it just becomes again acquiring the skill of not losing money. And if you keep the reps up and you're not losing money, you will eventually become profitable if you follow the process.
Mm. Well, Simon, it's been a pleasure getting a chance to interview you. Is it true you're a practitioner of Jeet Kune Do? What is that?
Yeah, so Jeet Kune Do it's the martial art that Bruce Lee discovered. Bruce Lee is often referred to as the father of mixed martial arts. He started studying Wing Chun under Ip Man. He wasn't thrilled by some of the more classical aspects of that art, and so he came up with Jeet Kune Do, which is sort of an amalgamation of Wing Chun, fencing, and Western boxing, to put it simply. I've studied many martial arts over the years. Martial arts have been a part of my life for most of my life, and I love all martial arts, but Jeet Kune Do is the one that resonated with me, and it's the one that I kind of took all the way, and I became a certified instructor.
Oh, that is great. I will say, no martial arts experience, but the movie Ip Man is a phenomenal movie.
Oh, brilliant movie!
Yeah,
Yeah,
it's
love
brilliant.
it.
Well, Simon, thank you so much for sharing your insights and your time, and thank you everyone for watching.
Absolute pleasure, Jack. Thank you.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.